bond market is made up of debt instruments of longer maturities than debt instruments traded in the money market. The bond market consists of instruments such as treasury notes and bonds, corporate bonds, municipal bonds, mortgage-backed securities, and federal agency debt. Financial instruments sold in the bond market are said to comprise of fixed income capital markets because they usually are fixed streams of payments determined by a specific formula. Treasury notes and bonds are debt obligations by the federal government that have maturities of 1 year or more. The federal government usually borrows money by issuing treasury notes and bonds. Treasury notes, also known as T-notes, are issued with maturities ranging up to 10 years. Treasury bonds, also known as T-bonds, are issued with maturities ranging from 10 to 30 years. Both treasury bonds and treasury notes are usually issued in denominations of $1,000. Both treasury notes and treasury bonds make semi-annual interest payments known as coupon payments. The reason they are called coupon payments is because before the days of computers, the bonds and notes actually came with attached coupons that investors would use to redeem their payments. Here is an excerpt from Treasury bonds listings pulled from the Wall Street Journal. The bond that is highlighted matures on November 15, 2015. The coupon payment is based on the coupon rate of 4.5% of the Treasury bond's face value. Therefore, since the face value is $1,000, the annual interest payment is $45. The coupon payment will be made semi-annually, so each coupon payment will be $22.50. The bid and ask price is on a percentage basis of the bond's par value. This means that the bid price for the highlighted bond is 112.9375% of the par value, equaling $1,129.38. And the ask price is 113%, equaling $1,130. The negative 0.438 change means that the closing price on the day dropped by 0.438%. Finally, the yield to maturity based on the ask price is 1.41%. All around the world, governments have issued bonds linked to indexes, which are based on the cost of living. They do this to provide investors with a way to hedge against the risk of price increases or inflation. In the United States, inflation-protected Treasury bonds are known as TIPS, Treasury Inflation Protected Securities. The principal of these bonds are adjusted according to the Consumer Price Index. Therefore, the payments which are based off of the principal are also adjusted for inflation according to the Consumer Price Index. The income earned on the bonds are considered to be risk-free if they are held into maturity. Sometimes government agencies issue their own securities as a source of funding for their activities. Usually these agencies are created because Congress believes that particular sectors of the economy are not receiving adequate credit through normal business of the private sector. The major mortgage-related government agencies are the Federal National Mortgage Association, known as Fannie Mae, the Federal Home Loan Mortgage Corporation, known as Freddie Mac, the Federal Home Loan Bank, and the Government National Mortgage Association, known as Ginnie Mae. It's always been assumed that the debt issued by federal agencies would be backed by the federal government. Although this debt has never explicitly been insured by the federal government, the assumptions were confirmed in September of 2008 when both Fannie Mae and Freddie Mac were on the brink of insolvency. The government stepped in, put them into conservatorship, assigned the Federal Housing Finance Agency to run the firms, and did in fact promise to make good on their bonds. International bonds. Firms often borrow from foreign investors, and many American investors invest in bonds from foreign issuers. Along with the American capital markets is an active international capital market, which is largely based in London. A euro bond is a bond that is denominated in a currency other than the currency of the country that is issued in. For example, a bond denominated in the American dollars but sold in Britain would be considered a euro bond. A bond that was denominated in British pound and sold outside of Britain would also be considered a euro bond. Since the relatively new European currency is referred to as the euro, it may be best to think of euro bonds simply as international bonds. In contrast, some companies will issue bonds in the currency of their foreign investors. For example, A Yankee bond is a dollar-denominated bond sold in the U.S. by a foreign borrower. Similarly, a samurai bond is a yen-denominated bond sold in Japan by a non-Japanese borrower. Municipal bonds. Municipal bonds, also known as munis, are bonds issued by state or local governments. Municipal bonds are similar to corporate bonds or treasury bonds, except they are exempt from federal income tax. Interest income on municipal bonds is also exempt from state and local taxation in the issuing state. Municipal bonds are, however, subject to capital gains tax if the bonds mature or are sold at a price higher than the purchase price. There are two types of municipal bonds: general obligation bonds and revenue bonds. General obligation bonds are bonds that are backed by the faith and credit of the issuer. Revenue bonds are issued to finance particular projects and are backed by the revenue earned from the projects or by the municipal agency in charge of operating the project. Usually, issuers of revenue bonds are hospitals, airports, and port authorities or turnpikes. Revenue bonds are of higher risk than general obligation bonds. One type of revenue bond is an industrial development bond. Industrial development bonds are issued to finance commercial developments such as large buildings or factories that can be operated by a private company. Industrial development bonds give companies access to the municipality's ability to tax-exempt borrowing. The federal government only allows a certain limit of these bonds to be issued. Municipal bonds have a wide range of maturities. A large number of municipal bonds consist of tax anticipation notes, which provide funds to pay for expenses prior to the actual collection of taxes. There are other municipal bonds that are issued to fund large capital investments. Municipal bonds can range in maturity up to 30 years. A key characteristic that distinguishes municipal bonds from other types of bonds is that they are tax exempt. Because of this feature, investors are willing to accept lower yields since the after-tax returns will be higher than a corporate bond that offers the same rate. How to compare after-tax returns of taxable bonds and tax-exempt bonds. When comparing tax-exempt bonds with taxable bonds, investors should always compare the after-tax returns provided by each bond. To compare tax-exempt bonds with non-taxable bonds, one must compute the actual after-tax returns considering all taxes on the income earned and realized capital gains. To solve for the after-tax rate of return, we use a simple formula. We let R represent the before-tax rate of return on the taxable bond, and we let T represent the combined tax rate for both federal and local taxes. To compute the after-tax returns on a taxable security, we use a formula R times 1 minus T. We then compare the after-tax return to the tax-exempt security. The investor will be better off holding whichever security provides the highest return. Another way to compare taxable bonds with non-taxable bonds is to find the equivalent taxable return. We let R represent the before-tax return offered by the taxable bond. T represent the combined federal and local taxes that the return on the taxable bond is subject to, and RM represent the return offered on the tax-exempt municipal bond. To find the equivalent taxable return, our formula is R equals RM over 1 minus T. Thus, it is simply the taxable yield divided by 1 minus T. The equivalent taxable return increases with higher marginal tax rates. Therefore, tax-exempt municipal bonds are more attractive to individuals in higher tax brackets. We can also use a formula to calculate the cutoff tax bracket. The formula is T equals 1 minus RM over R. The yield ratio RM over R is the key to determining the attractiveness of investing in municipal bonds. The higher the yield, the lower the cutoff tax bracket, and therefore the more individual investors that choose to invest in tax-exempt municipal bonds. Over the past 30 years, the tax-exempt to taxable yields ratio has fluctuated around 75%. This implies that an investor whose combined tax bracket is greater than 25% will earn a greater after-tax yield by investing in municipal bonds. It is important to remember that it's difficult to determine the differences in risk so these comparisons need to be made relative to the riskiness of the bonds that are being compared. Corporate bonds. Corporate bonds are long-term debt issued by corporations. Corporations use corporate bonds to borrow funds directly from the public. Corporate bonds are typically issued in denominations of $1,000, which is the principal of the loan and is known as the face value or par value of the bond. The more funds a corporation needs to borrow, the more bonds it will issue. Like U.S. Treasury notes, corporate bonds usually make semi-annual coupon payments until they reach maturity, at which time the principal or the face value is paid back to the lender. The coupon payments are the interest payments made to the purchaser of the corporate bond. Corporate bonds are riskier than government bonds. Default risk is a genuine consideration when investors purchase corporate bonds. Some corporate bonds are secured bonds, which have specific collateral backing them in the event of bankruptcy. Unsecured corporate bonds are known as debentures and are subordinate to secured corporate bonds. In the event of a corporation going bankrupt and liquidating, the secured corporate bonds would take priority to the company's assets over debentures. Sometimes corporate bonds come with options attached to them. One option that can be attached is for the issuing corporate bond to repurchase the bond prior to maturity at a stipulated call price. These types of bonds are called callable bonds. Corporate bonds can also come with the option for the bondholder to convert each bond into a stipulated number of shares of the company's stock. These are called convertible bonds. Corporate bonds are also traded in the secondary market. The market value of corporate bonds changes, and they are usually traded in the secondary market at a discount of the bond's face value or at a premium of the bond's face value. The return the purchaser of a corporate bond earns is known as the yield. The yield consists of the coupon payments the bondholder will receive plus the amount of profit or loss the bondholder receives whenever they sell the bond. Usually, purchasers of bonds will hold their bonds until maturity. The rate of return when a bond is held to maturity is known as the yield to maturity and consists of the coupon payments plus the premium or discount for maturity the bond was purchased for. The market value of a corporate bond continuously changes. Major factors that cause the market value of corporate bonds to change are monetary policy changes made by the Federal Reserve and the credit of the backing corporation. As interest rates rise, the market value of corporate bonds decreases, and as interest rates fall, the market value of corporate bonds increases. Mortgages and mortgage-backed securities. Years ago, investors were not able to invest in mortgage loans. However, in recent years, there has been an explosion in mortgage-backed securities allowing investors to invest in a portfolio of mortgage loans. Mortgage-backed securities have become an element of the fixed income market. Mortgages are typically long-term, 15 to 30-year loans with fixed interest rates for the duration of the loan, with equal fixed monthly payments. These types of mortgage loans are called conventional mortgages. Conventional mortgages can create problems for banks. Banks make money by holding long-term assets such as mortgages while issuing short-term liabilities. Long-term assets pay higher interest rates than short-term assets, allowing banks to profit. As interest rates increase, banks must make increased interest payments on deposits or short-term liabilities. However, the interest rates on their issued mortgages remain the same. As interest rates increase, banks may suffer. To remedy this problem, banks began re-engineering mortgage loans. One response was with the adjustable rate mortgage, which are mortgages that require borrowers to pay an interest payment that is tied to the current market's interest rates. This shifts the risk of fluctuating interest rates from the bank to the borrower. On adjustable rate mortgage loans, the interest rates may be set at a specified number of points above the rate offered in Treasury bills, and the mortgage may be adjusted once per year. Banks offer lower interest rates on adjustable mortgages compared to conventional mortgages since the risk of the interest rate fluctuation is shifted to the borrower. A mortgage-backed security is an ownership claim on a portion of a pool of mortgages or a financial obligation that is secured by a pool of mortgages. These claims represent a securitization of mortgage loans. Mortgage lenders issue mortgage loans, bundle them into packages of mortgage loans, and then sell them in the secondary market. What they are specifically selling is their claim on the cash flow that is to be received from the issued mortgages until the loans are paid in full. The mortgage lender continues to be the servicer of the loan, collecting payments of interest and principal, and then sends the payments to the purchaser of the mortgages. Because of this, mortgage-backed securities are known as pass-throughs. Investors can purchase mortgage-backed securities or securitized mortgages in the secondary market just as they can purchase bonds. Mortgage-backed securities have usually always been issued by Fannie Mae or Freddie Mac until recently. Most pass-throughs were comprised of mortgages that borrowers met specific credit qualities and underwritten guidelines before being purchased by Fannie Mae or Freddie Mac. However, in an attempt to make housing more affordable, riskier loans, also known as subprime mortgages, were made to financially weak borrowers and were sold by private label issuers. With the attempt to make housing more affordable, agencies were allowed to promote the purchase of these subprime securities. This turned out to be disastrous, causing banks, hedge funds, and other investors to lose trillions of dollars. The growth of the mortgage-backed pass-throughs has encouraged pass-through securities to be backed by other assets. These asset-backed securities have experienced rapid growth from a little over $300 billion in 1995 to around $2.5 trillion.